This is Money Mentors, where I sit down with curious minds of all ages and help them through their personal finance journey. It's all about the why, what, and how of money. Karan, welcome to Money Mentors. We're going to talk a lot about money and what to do with it. But before we do that, would you like to tell me a little bit about yourself?
Of course. My name is Karan. I'm 26. I am a stand-up comic. I'm also an actor and I write. And it's been, I think, about 4 or 5 months since I've been in Bombay.
Right, okay.
Before that, I was in Prague and I was there for a few years. I was teaching. I was also I went to film school and then I started doing stand-up comedy over there.
Correct.
So for a whole year, I was working in Europe. And I've just come back to India. It's been a good 5-6 months now.
So Karan, at Money Mentors, we have another little ritual that we do. You know, you've taken time out today. There must be some question in your mind. There must be some concern. We call it the confession. So something that you'd like to learn from this little conversation that we're going to have today.
No, absolutely. I want to kind of get my head around the inconsistent nature of freelance.
Right.
There's inconsistency not only in the amount of money you get paid, but when you get paid, and that's something that's been on my mind lately.
And I completely agree with you. I mean, people who start out in freelancing because there's so much of, uncertainty in terms of what you will have, but there is a fair amount of certainty in what you have to spend. So, you always have to do a little bit of balancing act in some sense. But, before we go any further, would you like to have something to eat?
Sure.
Yeah? Okay.
What are we going to eat?
Let me surprise you.
I'm very hungry all of a sudden.
Right.
Not as hungry anymore, but this doesn't look that bad. It's cheese and...
there's lots of cheese.
And bread.
And there's one bread. Okay. So, if you had to have this bread...
Yeah.
Okay. With the cheese, how would you do it?
There's a lot of cheese here, so I think I'm going to use a little more than I usually would. 3.5 slices.
Let's make it 4. Yeah?
Okay.
So out of the 20 slices of cheese, if you're going to utilize 4, you've got 16 left behind.
Yeah.
And in the financial world, we call that 16 as surplus.
I knew it. It wasn't about the food. It was about the bread. It was about clearly something else. So now I have 16 extra slices of cheese.
16 units of cheese or 16, units of money.
Right.
Surplus. So as a freelance professional, what is this surplus money? We need to identify what are all our inflows, resources, and things like that, and from which we are going to have a surplus. Because your expenses are pretty well known, they're defined, but your income is a bit uncertain, right?
Yeah.
And we're going to do a little activity, okay, by which we're going to arrive at a little bit of surplus.
Right.
Is that good?
Yeah, sure.
Okay, so that's what we're going to do right now. Let's first talk about income, okay? There are 3 broad categories, okay? Let's say there is a salary, there is a business, and rent. So salary would mean when you are employed with a company on a monthly basis and you get something there.
So salary is completely zero at this
right? So we'll just put a dash here. And for business, let's say, can you give me a number?
Yeah, let's just say 70,000 bucks.
Okay, so let's say there is 70,000 rupees that comes in here. Okay, would you have any rent coming in? Would you have a family property or your own property on which you're earning any rent?
No, it's just a lot of rent going from me, but I don't have any.
Okay, that's fine, no problem. So we are at 70,000. Now we'll move on to another area, obviously, which is expenses, all right? Let's say living expenditure. Then there is lifestyle.
I have those.
Plus, let's say, a little bit of entertainment. And then there is another popular one, which is rental. Or a lot of people also have home loan EMIs.
Rental, you can say 20,000.
Okay, so we'll write 20,000 there.
My living expenses, including all the food and everything that comes
Food,
in.
groceries, bills, utilities, etc.
15 to 20,000 bucks.
Okay, let's call it 20. And would you have some personal expenses, entertainment,
Let's say 10,000 to 15,000 bucks.
Okay, let's go with 15.
Okay, sure.
Okay. So this totals up to 55,000.
Gotcha.
Good? Now we're going to do a little analysis of this. We know that our income there was 70,000.
Yeah.
We know our expenses here is 55K. The S, or the surplus, or what we saw as the 16 slices of cheese, is equal to
15,000 bucks.
15,000. Fabulous. This is where we stand. And it is this surplus that we need to sort of identify. Can you relate to this ideology? This is called budgeting.
I don't do this a lot. So I don't exactly know what to do. That's also a question to you. I don't know what I can do with this 15,000 because also it's not necessarily the case every month. It fluctuates as well.
Absolutely, absolutely. We've identified the resources, okay? We've come to the surplus, and we now need the knowledge resource of how we're going to use it. But before we do that, we're going to do another little conversation just to sort of get you understanding this thing a little better. So very often, because people don't do this, do you know what happens? Take a wild guess.
They're broke.
Surplus is zero because they'll always feel, oh, I just don't have the money. You know, I don't know how to make an investment. I don't know how to make a saving. There is just never a surplus because you're never thinking about it.
Yeah, I know that feeling very well.
First, identify the surplus. We have a surplus and we've got to do something with it, right? Now, whether your income is consistent or not consistent, whether you're doing freelance or whether you're running into a profession or whatever you're doing, most often in life, if you can hit a 20% number in terms of your surplus, you're actually doing financially quite okay to begin with. Whenever that money comes in, if a 20% from there could be diverted into some investment, if nothing else, divert it into another bank account, so at least you don't spend it.
How do we sort of now tackle it under the context of freelance?
In your case, whenever you get that money, let a 20% move out. Because you see, you would have got some money today and you're running a few months with it.
Right.
If you're getting consistent assignments, then you are making consistent income. If the assignments are a little haywire, that's okay, but you still have the reserves of the previous assignment, which are taking you on for the first month or the second month. The second thing is your personal expenses. I want to put a ratio on that number too. 30% is the number. You know why? Because from the remaining 50%, you can actually build assets. If, by the way, you're thinking of buying a car or you have a bike or something like that, then all your EMIs put together should be within that 50% because that's healthy. 20, 30, 50 are your three sacrosanct numbers.
Okay, nobody ever put it like that before. This makes it sound a lot simpler.
Lot simpler, doable, right?
I've often found that people who have a consistent earning tend to be better at saving. Whilst my experience with freelance has been that there have been months where the months have been very bad, but suddenly older money that I was supposed to get comes much later, and then suddenly I get all of it at the same time. In that, how would you sort of advise me to develop a better habit of saving given that I don't have a consistent income?
It's a little bit of personal discipline that also comes into play. Once you do it often, it'll just become a part of you. Let's say, call it your general account, wherever you're getting your credit in.
Right.
Okay. The moment you get your credit in the general account, pick up for 20% and park it into investment account. I know you're closing debts and things like that. If you can't do 20%, doesn't matter. Can you do 15? Can you do 18%? Can you do 12%? Can you do 5%? Pay yourself first, no matter what you do. Because if you don't take out that some part, you will always be waiting for that day when you will have 3 crores and 2 lakhs and 5 lakhs.
You're right.
Let me have that money, then I'll go and invest. So we've sort of understood the resources. What we now need is a little bit of knowledge resource. If the money is in a savings account, what are we earning? 3%. Let's go like a notch higher, okay? What is the next thing that people do with banks?
I want to say rob a bank, but that's really not the answer. So I know very little about this.
Let's say we'll make a fixed deposit in a bank.
Oh, yeah, of course.
So fixed deposit, what do fixed deposits earn? About 5 to 6%.
Okay, not that much.
All right. Once you get into the space of investment, people tend to buy insurance policies.
Right.
Okay. So typically, what are we going to earn in these products? The same 5 to 6%. Other products, government products. And it's a very popular option, right? So PF stroke PPF, and that is 7%. You understand these products, right? A lot of our investments also go into ULIPs.
I've heard of this.
Yeah, ULIPs are insurance plans. They're like a mutual fund, but they are offered from an insurance company. So it's like a combination product. You get a life insurance also, plus you get to do some investments also.
Right.
And it's a better investment because it goes to the stock market and it grows also over a period of time. So what can we expect to sort of earn from here? Say 9 to 15%. Okay? Then, have you heard of mutual funds?
Yeah, of course.
Okay? MF, mutual funds, and where we invest into equity. Maybe 12 to 18%. And of course, you've heard of the stock market.
Yeah.
We buy equity shares.
Yeah.
I mean, these are just like a list of popular things that we can do. Equity shares. Okay? About 14 to 18%. 18% plus. So the reason I put so many pluses here is because there's no upper limit to it. You
Right,
can make a phenomenal amount of profits. Now, I'm just going to go quickly to the other side. There's something that you mentioned. You have some deposits, right?
Yeah.
And look at the rate of return your deposit is earning, 5 to 6%. So even if you were to sort of move this money to here or here, don't you think this money would actually grow and it'll help you in months where there is inconsistency?
Yeah, no, for
Wouldn't
sure.
that be a good idea?
For sure, but can I ask you a few questions on the
Yes,
specifics
please,
of some
please
of these
go.
things? So, can you describe to me what ULIPs are a little bit, and can we get into that?
The full form is unit-linked insurance plan,
Right.
provided by an insurance company. That's the manufacturer. What they do is this is a combination of, let's say, life insurance plus investment. You pay a certain amount of money into this product. It's known as the premium. A tiny part goes away for your life insurance, or let's say a small part.
Right.
The rest of it goes into an investment, and that investment portion pretty much works very similar to a mutual fund, which is investing in equities or
Right.
bonds or debt funds or whatever.
If I had to compare ULIPs to, let's say, just a different insurance.
Broadly speaking, the rules are the same in terms of the coverage. But what happens is, this is the unit-linked insurance plans. These are the insurance policies that you're talking about. These are the traditional policies.
Right.
Where the difference between this and this is, in this traditional insurance policy, you don't get to choose where your money will be invested.
Right.
And therefore, in ULIPs, you could actually land up making a much higher rate versus this insurance policies where we're thinking, this is a
Right.
projection.
Would you say that is still an interesting or like a useful option to actually rely on for actual health coverage?
You need health insurance because something might happen to your health. Health insurance is outside the purview of investments. It's not an investment. So your health insurance premium would fall there because you have to pay it so that you don't land up, spending all your investments if there is a medical situation.
And one thing that I don't see here,
Yes.
but I wanted to ask about was debt funds.
It would sort of come here. I just put everything as bonds. What does a
Right.
debt fund invest into? They invest into government bonds, state government bonds, RBI bonds, all of that.
Right.
You can buy bonds directly also, independently also. So I
Right.
just clubbed the entire fixed income investment category into these bonds. This is just conceptually to understand. We have resources. How do you manage resources? How do you create a budget? You had a surplus. What do you do with the surplus? You invest it. To invest it, you need to have the knowledge resource.
Right.
So this is your knowledge resource.
So with higher rate, you also have a tendency for higher risk, I guess, and in that.
So we don't call it risk. I don't like to call it risk personally because it's affected by economics, supply, demand of products and
The nature of
services.
the market.
Nature of the market. It's up and down because it's demand and supply. It's emotions also involved in this thing.
Yeah.
Every year the company may not be at the same consistent profit. Sometimes it could be larger profit, sometimes lesser profit.
Right.
But as investors, you invest and stay put, and that's how you'll make a lot of money.
Yeah. Okay. Got it.
So Karan, we have yet another ritual at this point since you've enjoyed the conversation. There are some 3 or 4 key takeaways that you might want to talk about. Something that you will go out of the room and implement, or tomorrow morning you might want to start actioning.
No, for sure. The first thing, of course, to even get presented such a structure tells me that I need to go home and identify the extra money I can get every month.
So identify your surplus. Everyone has a surplus. There are situations in life where sometimes you may not have. But broadly speaking, everyone has a surplus. You just have to go and identify where is your surplus.
And I guess the second one is linked to the first. It is to really just develop a better relationship with budgeting.
So you need to create a budget, and not only create a budget, review that budget every 6 months.
Yeah.
Because things keep changing, you know.
And I think the third takeaway, which again is informed by the list you've just written on the board right now,
Right.
is perhaps to transfer the deposits that I have, the fixed deposit,
Correct.
to something that might give me a little more return.
Take better investment decisions. And let me give you a little tip here as well.
Sure.
You know, there are certain mutual funds, if you invest in them, you also get a tax deduction or a tax benefit known as ELSS, equity linked savings schemes. You could actually put some money into that. So if you have to pay tax at the end of the year, you might actually save tax. You are, killing 2-3 birds with the same stone.
Okay, that's amazing to know.
You're making a better investment decision. You're moving into an asset which is going to create more money for you.
Yeah.
You're saving on tax. It's a no-brainer then, because this is what's going to happen. So thank you, Karan. It was wonderful having you today at Money Mentors.
Yeah, likewise.
Thank you all for joining in, and I do hope that you've had some really good takeaways for yourself too. I know there's a lot to learn, but one step at a time, right? So stay tuned. This is Money Mentors, and this is where we show you how to make your money work for you and kickstart your financial journey. See you next time.